Warren Buffett's largest transaction this year was selling over $100 billion of Apple stock, while also investing $545 million in new stocks. It's like navigating a storm. You must know when to adjust your sails and when to chart a new course. We'll explore why Buffett's shifting from tech giants to oil, radio, and internet infrastructure. You'll learn how to interpret market trends and make informed decisions even when the economic outlook seems unpredictable. In the next few minutes, we'll examine the problem, uncover Buffett's solution, and reveal the potential results of his strategy. By the end, you'll be better equipped to read between the lines of market trends, even in uncertain times. Did you know that Warren Buffett's biggest move this year wasn't a purchase, but a massive sale? The Oracle of Omaha just made waves in the investment world by selling over $100 billion worth of Apple stock. This unexpected shift has left many investors wondering what it could mean for the tech giant and the market as a whole. For years, Apple has been a cornerstone of Buffett's investment portfolio, seen as a reliable and profitable holding. So why the sudden change of heart? As technology evolves, even once revered giants must adapt or risk obsolescence. One potential reason behind this surprising sell-off could be the perceived risks facing Apple in the rapidly changing tech landscape. As consumers increasingly prioritize AI capabilities over traditional hardware features, there's a growing concern that Apple's pricing power could be threatened. This shift in consumer preferences might be causing Buffett to reassess the long-term value of his Apple investment. But it's not just about changing consumer tastes. The current market conditions are likely playing a significant role in Buffett's decision. Apple's growth has been showing signs of stagnation, making it less attractive compared to emerging technologies. With premium trading multiples and a lack of substantial growth, Apple might no longer fit the bill for Buffett's value investing strategy. This move raises some intriguing questions about Buffett's confidence in the tech sector as a whole. By reducing his holdings in such a stalwart company, Buffett might be signaling a broader shift in his market outlook. It appears he might be moving away from the tech stocks and towards sectors he perceives as undervalued or with better growth prospects. To understand this, we need to look at the broader economic context. We're in a period of significant change, with rising interest rates, inflation concerns, and geopolitical tensions all impacting the market. In such an environment, Buffett might be seeing opportunities in more traditional, less glamorous sectors that others are overlooking. Consider the possibility that Buffett is eyeing industries that are essential to the economy but have been undervalued in recent years. Sectors like energy, manufacturing, or certain financial services could be prime targets for his value investing approach. These industries might not have the flash of big tech, but they could offer the steady, long-term growth that Buffett is known for seeking. Moreover, Buffett's move might reflect his views on overall market valuation. If he believes the market, particularly the tech sector, is overvalued, this sell-off could be a way of reducing risk in his portfolio. It's a reminder that even the most successful investors constantly reassess their positions and adapt to changing market conditions. But what does this mean for the average investor? Should we all follow Buffett's lead and sell our tech stocks? Not necessarily. While Buffett's moves are always worth paying attention to, it's crucial to remember that his investment strategy is based on managing billions of dollars over very long time horizons. His goals and risk tolerance might be very different from yours. Instead of blindly following Buffett's moves, use this as an opportunity to reassess your own investment strategy. Are you too heavily invested in tech? Have you considered the potential risks and changes in the sector? Are there other areas of the market that you've been overlooking? While many investors are turning away from fossil fuels, Warren Buffett just poured over $400 million into them. When most are fleeing fossil fuels, Buffett dives in. What does the Oracle of Omaha see in this industry that others are missing? His recent investment in Occidental Petroleum might reveal a hidden opportunity in today's volatile market. Let's break it down. Buffett's Berkshire Hathaway recently scooped up a significant number of Occidental Petroleum (OXY) shares, paying between $45 and $47 per share. This move is particularly intriguing because it comes at a time when oil prices have dipped below $70 per barrel. So, what's driving this decision? Buffett's investment in OXY is an indirect wager on the future of oil prices. Remember, Buffett previously bought OXY shares when oil was hovering around $80 per barrel. By doubling down now, he's signaling a belief that oil prices will stabilize or even increase in the future. For companies like Occidental Petroleum, oil prices are the lifeblood of their business. In fact, for every $1 change in the price of West Texas Intermediate crude oil, OXY's annualized cash flow changes by approximately $240 million. That's a massive impact on the company's bottom line. You might be wondering, isn't everyone moving towards renewable energy? Why invest in oil now? That's a fair question, and one that many investors are grappling with. But here's where Buffett's long-term vision comes into play. While there's a global push towards cleaner energy sources, the transition isn't going to happen overnight. Oil and gas still play a crucial role in our energy mix, and they're likely to remain significant for years to come. Let's take a closer look at Occidental Petroleum. The majority of the company's value comes from its domestic oil and gas production assets. But OXY isn't putting all its eggs in one basket. The company is also venturing into decarbonization efforts and chemical production. This diversification could provide some insulation against the volatility of oil prices and position the company well for future energy trends. Speaking of volatility, the current state of the oil market is anything but stable. We've seen prices swing from nearly $90 per barrel to under $70 in recent months. These fluctuations have naturally affected the stock prices of companies like Occidental. But for a value investor like Buffett, this volatility might actually present an opportunity. Buffett has a history of making energy investments with a long-term outlook. He's previously invested in companies like Phillips 66 and holds a significant stake in Chevron. This consistent interest in the energy sector suggests that Buffett sees enduring value in these companies, even as the energy landscape evolves. The oil market doesn't exist in a vacuum. Geopolitical factors play a huge role in influencing oil prices and, by extension, the performance of companies like Occidental. OPEC's production decisions, global demand fluctuations, and even political tensions can all impact the price of oil. Buffett's investment suggests he believes Occidental is well positioned to navigate these complex dynamics. So, what might Buffett be seeing that others are missing? He could be eyeing the potential for undervalued opportunities in the oil sector. As concerns about inflation grow and energy demand remains resilient, oil companies with strong fundamentals could be poised for growth. Occidental's diversified approach, combining traditional oil and gas production with investments in newer technologies, might make it particularly attractive. Buffett's move could be a hedge against economic uncertainty. Oil has historically been seen as a hedge against inflation, and with economic indicators sending mixed signals, this investment could be a way to protect against potential market downturns. Buffett's strategy isn't just about picking individual stocks. It's about seeing the bigger picture and positioning himself for long-term success. His investment in Occidental Petroleum is a calculated move based on years of experience and a deep understanding of market cycles. What if outdated technology was hiding a secret treasure trove of value? That's the question Warren Buffett's latest investment raises. The Oracle of Omaha has just poured $100 million into SiriusXM Holdings, a move that's turning heads in the investment world. With shares trading at $2.22 each, Buffett now holds a significant 30% stake in the company. But why is he betting big on a technology many consider past its prime? The audio streaming industry is evolving rapidly, with traditional radio facing stiff competition from platforms like YouTube. SiriusXM has been grappling with declining revenue trends both in subscriber and advertising revenue. So what's Buffett seeing that others might be missing? SiriusXM's management has a clear goal: to generate between $1 billion and $1.5 billion in free cash flow over the next few years. That's impressive for a company with a current market cap under $8 billion. If they hit these targets, SiriusXM could be trading at just 5 to 7 times its free cash flow, a potential bargain in Buffett's eyes. But there's more to this story than just numbers. Buffett's investment raises intriguing questions about the long-term viability of satellite radio. While many investors have written off companies like SiriusXM, Buffett's move suggests he sees hidden value. Could it be in SiriusXM's technology or content? The company does have a unique position in the audio entertainment landscape, with exclusive content and a captive audience in vehicles across North America. As more vehicles become connected and autonomous, the demand for in-car entertainment could skyrocket. SiriusXM, with its established presence in the automotive industry, could be perfectly positioned to capitalize on this trend. Keep in mind that Buffett isn't just making isolated investments, he's building a media empire. This move could be part of a larger strategy to consolidate media assets and create value that isn't immediately apparent to the market. In a world where many tech companies burn through cash in pursuit of growth, SiriusXM's steady cash generation could provide stability and options for future investments or acquisitions. Of course, this investment isn't without risks. The audio streaming market is fiercely competitive, with giants like Spotify and Apple Music vying for listeners' attention. SiriusXM will need to innovate and adapt to maintain its relevance. But if anyone can navigate these challenges, it's a company backed by Warren Buffett's expertise and resources. The key is to look beyond the surface. While declining subscriber numbers are a concern, Buffett may be seeing a future where SiriusXM isn't just a radio company, but a key player in the broader entertainment ecosystem. As we've seen with other seemingly outdated technologies, sometimes the most unexpected investments can yield the greatest returns. So, as we tune to this unexpected move, we're left wondering, what does Buffett hear in SiriusXM's signal that others are missing? Only time will tell if this investment will be another masterstroke from the Oracle of Omaha, or if the static of changing consumer preferences will drown out the potential. One thing's for sure, in the world of investing, it pays to listen carefully to the signals others might be ignoring. As we conclude our exploration of Warren Buffett's recent investment moves, let's focus on the key lesson. Successful investing is about long-term potential and intrinsic value, not following the crowd or chasing trends. Buffett's approach shows that even in uncertain markets, opportunities for value investing exist. The Oracle of Omaha's strategy emphasizes patience, discipline, and looking beyond market noise. In today's fast-paced world, it's crucial to step back and focus on a company's underlying strength and potential. Imagine approaching your investments with Buffett's mindset. How would it change your decision-making? Here's a challenge. Take a look at your portfolio through Buffett's lens. Are you considering the long-term potential of each investment? Are you focusing on fundamentals rather than short-term fluctuations? Remember, building wealth is like planting a tree. It requires time, care, and the right conditions to grow. Your investment choices today are the seeds you're planting for your financial future. Keep in mind that Buffett's approach might not suit everyone. The key is to develop your own informed perspective, balancing risk and potential value based on your financial goals and risk tolerance. By doing so, you'll be better equipped to navigate the ever-changing financial landscape. Next time you face an investment decision, ask yourself, am I looking beyond surface-level trends? Does this align with my long-term goals? By asking these questions, you'll be on your way to making more informed, confident investment choices. So as you consider your own investment strategy, remember that successful investing isn't about making quick gains. It's about building wealth over time through thoughtful, well-researched choices. By developing your own informed perspective and staying true to your investment principles, you'll be better positioned to achieve your financial goals in the long run.